there's nothing going to improve upon perfection. Like, I'm literally able to tell you beforehand, you're seeing it in your own charts, where the market will respect these inefficiencies, the highs and the lows, and then they'll revert them one more time in the future. And then they'll act as what you would expect a support resistance theory to do. But guess what? They don't teach inefficiencies like that. Chris Lloyd doesn't use an old imbalance as support resistance. It's one and done. This one's done. That's his words. It's verbatim. He's done with it. The guy he learned from, that's the logic that he had. That's the differentiation between me and him and everyone else. These very specific TD arrays, they're not rooted in retail. They're algorithmic. These are things that are going to repeat. But if they don't even get traded to, that tells you something. It's, well, in this case, for the S&P, I'm not the S&P, the NASDAQ, it's decidedly weak. And it's going to start going lower and start looking at every premium array, every up-close candle as a bearish order block, and aim for the liquidity, because there's no inefficiencies to the left once that afternoon 1:30 rally happened. Everything was liquidity, sell side. It just so happens that it ran out of time before it got there. So that's why I'm saying that I expect it to gap down there on Sunday's opening, or gap opening lower and then trade down there on Sunday going into Monday's London session. That's what I anticipate. I feel confident in saying that because we didn't do it on Friday. And there's nothing else for it to be reaching down there for. And it would make perfect sense to wipe the board for everybody that tried to pick the bottom in fall, September, and October low. I'm listening to people on CNBC, oh, the low's in. People are going to be really caught off guard because they want to see this, the stocks are going to go higher. Where are they at right now? They overexposed themselves. They married the vein. They went out there and they went all in. You ever seen that movie Rounders? It's one of my favorite movies. The Russian KGB. He's playing poker with Matt Damon. He's taking his chips, saying, I'm all in. He's splattering all the chips and stuff. Real cocky, real arrogant. He knows everything. He thinks he's got Matt Damon over the barrel. Overconfidence. Overexposure. And Matt Damon kills him right then and there. And he zaps out. That's how you react when you think everything for that one trade you're in. Because look at the climate. All this stuff's going on. This guy was talking to me last week on Twitter. Thought he knew everything. You know, oh yeah, you want to be trading. Well, I don't think it was last week. It was the week before. These are the best times to trade. But he just announced publicly that he just found profitability. So if he just found profitability, he doesn't have track record. He doesn't have the ability to stay profitable. He's just now tasted it one time. So now that's who becomes the mentors. That's who becomes influencers. Which is one of the things I hate about social media. You have to be with someone. Spend time with them. Because if they know what they're doing, you're going to see it. There's no doubt about it. You will know absolutely that there's valid theory being implemented. It's not contrived. It's not being pulled out of your ass on any given moment. Oh, this is pulled out of thin air and here it is. And just, dazzle them with bullshit. That's not what this is. This is logic that keeps repeating. I'm teaching you how to protect yourself, which is first and foremost. Capital preservation is the first thing that you have to have in your head. That, okay, there might be an opportunity there, but in the event that it isn't, I'm not going to over leverage and I'm not going to push too hard. I'm not going to do 5 trades today just because there's something going on around the world that's causing the market to move all around. So therefore, I see that as opportunity and I might catch a big run. Might needs to be underlined, highlighted. Might is not a absolute. Might is not a definitive absolute. You're going to have that happen. It might. And what I've learned in 30 years is those invitations where things might happen in your favor are more apt to be against you. But you went into this with the only wearing rose-colored glasses, and it's only going to be your outcome that's going to come that way. And you wrestle with it, and you arm wrestle because you have spent the whole weekend. It's going to be a big mover. There's going to be a lot of speakers. There's going to be red and medium impact folder events around the economic calendar. That means there's going to be a lot of movement. And I'm a trader, damn it. I'm going to go out there and I'm going to trade into drawdown, into losing your account, into failing your combine, into needing a new reset. I'm trying to spare you that, because even though they may be limited in scope in terms of, okay, say you lost your funded account, big deal. What did you really lose? You just got to pay the fees to get back into it again and put the time in to get it back. Okay, it's an aggravation. Is it the end of the world? No. If you lose your account with your own money and you had, I don't know, 100,000, 50,000, 75,000, whatever it is that you would have in there, 10,000, 5,000, whatever it is, if it's real money that you put in there and you lose it, that hurts. That hurts. That's like a kick in the stomach. It didn't just, ow, that hurt, and it goes away real quick. It hangs around for a little. It's like a liver shot. It just takes everything out of you and you're hitting the floor. Because that was your money that you worked very hard saving up, and you invested it with intentions of growing it. But then you didn't execute with a model. You didn't think about the things I'm talking about in this discussion today, which is identifying invitations to overexpose yourself. Just because there's going to be a potential for high volatility doesn't mean that you should be in those waters swimming around. In other words, I looked at this week that we just closed much like I view non-farm payroll, where yes, everybody expects some measure of volatility. Absolutely. It goes without saying. There should be, and it's reasonable to assume that there's going to be volatility when 8:30 comes on non-farm payroll Friday. The reaction to those employment number data is going to create this excitement to be a participant in the marketplace. And the market participants are being led astray by the algorithm and or manual intervention that creates these price runs higher or lower. And they want you to chase it. That's not buying and selling pressure that's causing those extrapolations higher and lower.